Good evening, ladies and gentlemen. A very warm welcome back to you on our top series, Market Masters, where you get to meet the finest brains on Dalal Street, professionals who've made tons of money for their subscribers, for their mutual fund holders, and for their PMS schemes. It's my pleasure to welcome Mr. Deepak Shenoy, Chief Executive Officer at Capitalmind. The company offers 3 PMS schemes as also is now a mutual fund. Deepak has traded in many markets, invested in all bulls and all bear markets over the last 3 decades, and is now a veteran on Dalal Street. Namaste to you, Deepak ji, and a very warm welcome. We get to talk to each other once this GST rejig has happened, and of course the market reaction is upon us. Is this a correlation that you can sort of help our viewers with, that the GST rejig happened and the markets reacted a bit negatively? How are you seeing sentiment on the Dalal Street at this point?
So to be fair, firstly, thank you, Shalendra, for all the for the introduction. I feel here GST's change, as we were talking about how surprising it is that something as bullish as this is taken relatively with a relatively benign market move, and the same thing on the other side. Where we've had a war or American tariffs put upon us, have also had a muted negative reaction. So there is not that much positivity in positive news, and there's not that much negativity in negative news. So the market seemed to be a little fatigued of news, perhaps, but also not reacting as strongly as they used to do in the past.
Yes.
I feel that the GST news is very positive because I think it will increase affordability in discretionary purchases, not so much in things like FMCG or what are called staples. So, you will not buy substantially more cereal just because GST has come down, but it makes it more affordable to you. May afford a higher brand of cereal or a different form of the exercise. You may change your consumption pattern, maybe add more of proteinaceous substances in the food category, change the car that you may buy, but it may not necessarily affect the staples as much.
Fair point. Deepak, you manage somewhere like 2000 crores in the PMS and the mutual, recently launched mutual fund for retail clients. Now tell us, at this point of time, how is the overall portfolio structured? What are you betting in terms of strong earnings growth, in terms of better market share, in terms of maybe a good stock price appreciation? We have Q1 behind us, and it's not been a pleasant journey.
Yes, I think Q1 in general has been kind of okay because we had a couple of good months in Q1 from a market price perspective, but not so much in the third month. So April and May were decent, and June was not. So what I feel here is that we're in the beginning of perhaps or the end towards the end of a flagging market. So where you kind of have fatigue on a lot of sides. As much as the buying is done, is not coming. There's not much selling coming in either. So there's a kind of a flagging down in that sense. Our portfolios have two layers, right? So we have a quantitative portfolio which just basically uses market data, both price and fundamentals, to determine the next kind of way forward. And we found over here that some companies in the digital space, the relatively new startup spaces, they have done very well in the last few years, and that could be from a financial angle, companies in the financial space, or companies in travel, transportation, companies in the hospitality industry and in the hospitals industry. So in that sense, we've seen a bunch of those. We also have a large amount in our fundamental portfolios. We have a large focus on the manufacturing sector. we apart from these areas, we feel domestic consumption is growing, but also domestic manufacturing has got a lot of impetus. There
Right.
is a tremendous amount of focus on infrastructure and companies that are doing relatively high capex, and companies that benefit from that. So whether it is an electricity downstream company or a company that profits from an increased building of roads or rail infrastructure. These are companies that also exist in a fundamental portfolio. So I think we call that Surge India in the PMS. That's kind of more focused towards what India produces for itself. And I think that has now become, because of America's tariffs, it's become more and more in focus, saying we need to produce more for ourselves and rather than trying to import from some of these other nations.
Right. I think fairly early, once the income tax cuts were in place, fund managers, including you, were focused on the domestic of the Indian economy, hoping that you would have a surge in local consumption. Of course, these GST rejig plus the 100 basis point cut in rates positive. When you look at or when you expect Q3 earnings against the backdrop of these two or three positives, is there a chance?
Sorry, I lost your last part of your question. You said, is there a chance?
For the market to be re-rated upwards majorly?
Think the market has gone through kind of a boring phase. Now, usually boring phases end up with exciting phases. Now, the exciting phase could be exciting on the way down, exciting on the way up. I can't predict that, but I think the markets do deserve, to be re-rated when there is a fundamental change, and there has been fundamental changes. There has been a big impetus on domestic manufacturing, a big impetus on lowering rates, increasing amount of discretionary income in the hands of people through a tax cut initially from income tax and also a tax cut now in terms of GST. So there is reasons why there should be a bull market going forward, but those reasons not necessarily do they actually combine. So lots of uncertainty, right? This 50% tariff could become 100% tariff. They are talking, not making noises about tariffs on IT. Of course, we will retaliate and put tariffs on their services. That is a guarantee, but that will hurt both players. It won't help either. The idea is to find out who gets hurt the most, and if therefore one area or one person should kind of give up, or both countries can come to a compromise. But I feel there is a little more pain in that area in terms of uncertainty. So while
Yes.
that lasts, we will probably still go through this, up and down kind of phase. While good companies demonstrate their ability to generate earnings even out of such markets, and that is where the potential for fund managers for like us lie.
Right. Uh, Sticking on to this problem that we are facing with the world's largest economy, you recently tweeted that Trump is alienating India, and we really want to get to a situation where we don't have to care at all. Has the country, which is India, started to move towards that edge that we don't care a lot?
So we've never really cared. I mean, to be honest, we've just integrated in the world economy only in the last maybe 20, 25 years. We've always had a layer of seclusion because nobody really wanted to help us unless their own interests were met. So to that extent, look, for instance, there was a famine in 1960 something, and then America was asked to give excess wheat to India. Of course, when America is asked to give, any country is asked to give anything, they give it as a loan, not as a grant of that sort. So there was, we didn't have the money to pay for it, so we said we'll pay for it later. And they put conditions like you should move away from Russia. That caused us to get even more steely in the sense we need to be more dependent. We started the green revolution immediately after with the help of the World Bank, but it has resulted in a situation where we don't have to ask other countries for food ever again, most likely, because our food generation is so high that if India stops the export of wheat, the world starts getting worried because we are one of the largest. After you, I think Ukraine was one of the larger exporters of wheat, but we were supposed to make up for their lack of exports when they were in the war. So similarly, I think in a lot of other cases, India has kind of been isolated from a lot of things. So, for instance, we had to develop our own nuclear technology, our own space technology because they wouldn't help us. We had to a very large extent, we have been seen as people or a country that just does low quality labor in the initial part, which was we were fine to do. But as we scaled up, some of our IT companies are starting to higher and higher end things. Our own domestic economy has developed to a point where the demand domestically is high enough for our financial services companies, even our IT companies, to generate a lot more digital solutions for the Indian workplace. Our financial system has evolved digitally in a format that is probably one of the best in the world in terms of
Correct.
payments. So a lot of this domestic development has come without. So, for instance, we chose a UPI over a Visa and a Mastercard.
Correct.
Uh, and why we do that was because not just because of anything else, but because Visa and Mastercard are controlled by America and they have militarized that control. Like for instance, in Russia, they stopped the operations of Mastercard and Visa overnight. So if Russia was entirely dependent on a Visa or Mastercard ecosystem, they would have been finished as an economy. But even they were not. They chose their way out in different ways. And now India has also got something else that ensures that we are independent of such players when it comes to payments and the financial system. Our financial system is almost entirely domestic. Our retail system is almost entirely domestic. So we have been making efforts to ensure that other countries do not cripple us
Yes.
in case they have used differing from us in military conflicts. Even in America's case, they have shown their allegiances to Pakistan, which is not really a friendly country to us. So, to the extent that their trust is there, we will not trust them more than we should, given going forward. So, I think this self-reliance in that sense is a real need and probably will take a decade to do, but it will push more domestic companies to produce for our own needs. And right now, we are nowhere near ready. We will just
Right.
started the journey till there.
Yeah, I think it's been very wonderfully explained, Deepak ji. And yes, we started out as back-end service providers in terms of IT. I'm sure you remember the Y2K revolution in 1996 to 1999, and then came the dot-com bubble. We were all, in terms of IT, looking to the overseas markets, and now something internally is developing, and all points taken, next decade will see Indian self-reliance take on new heights. Now so far what we were looking at was China as an adversary over the last 4 years, and now suddenly the bonhomie is back. Do you think in the minds of global corporations who are looking to outsource their supply chains, maybe diversify them, this China plus one, which was India, uh, has it been diluted?
Well, to be fair, we are too small to be China plus one. I think we're very, very, very small. I keep saying we are China plus 0.05. We are that small in comparison with the size and the scale of what China is in terms of manufacturing production. So if you want to be plus one, we are going to go a long, 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 long way to go. So we may be able to produce, for instance, iPhones, relatively high ticket items, but the scale of what they produce from chemical APIs to to plastic goods and to manufacturing in general, I think we are not anywhere close. We don't make our own sewing machines, even though we are the world's second largest textile exporter. 99% of our sewing machines come from China. We are not anywhere close to China in terms of manufacturing a whole host of non-electronic exports as well, non-electronic goods as well, whether it is toys or things like that. I would say electrical machinery, things on around the industrial machines, we are relatively lagging behind. So we will take a while before we get into a replacement kind of a, to get to that point. But I think politically, while this close and far thing keeps happening, by trade, we have been very dependent on China. So we import a lot of things from China, including for our chemical exports. A lot of the APIs come from there. Our pharma exports, a lot of APIs come from there. A lot of other chemicals, other core infrastructure, rare earths, imports. A lot of this comes from there. Even though India has the resources, India is the second largest or third largest, maybe source of rare earth materials, but yet we haven't developed those rare earths, whereas China has. So I think, from that perspective, we have a way to go. I think politically we've gotten closer, but I think still there is going to be a point at which, our interests will not align. Again, China is close to Pakistan. They have funded them with their planes and aircraft engines and so on.
Right.
I don't think we should rely on this political partnership lasting a whole lot more than maybe a few years.
Right. Let's come back to the Indian markets. Look at how Indian equities have underperformed over the last 1 year or so. In the last 2 months, you've had net outflows from FIs to the tune of about $10 billion. In fact, more than that. Do you see any kind of reversal happening in FIIs? If yes, what would be the trigger?
So FIs have become a smaller and smaller portion of the market. So while they've gone out, there's been a lot of domestic inflows that's come in and balanced out for the most part. They're coming in now. At some point there will be a change. That change may come because of stability worldwide, lack of hostilities or cessation of hostilities with the US, an understanding that our markets are going to demonstrate even more growth than they have. They have done about 12 to 13% per year, but when there is a change, that will come in as well. And lastly, when there is, I think, geopolitical stability worldwide now, it's early to call for that, but I would say at some point, if the Indian market performs okay, right now it's not doing that great, there'll be a point at which it starts doing well. And then that's the time when, even FI will be like, oh, why should I miss a good bull run? No matter where it's happening across the globe. And that's when money will also start pouring in. Uh, Earlier, it used to be the FIs that would create the bull runs. They would be the ones that
Yes.
would spend money. Today, I think they will just participate in them. So while
Okay.
there isn't one right now, that's fine. But when there is one, they will come in, and domestic inflows are likely to continue. So if you add domestic inflows, which currently balance FI outflows, with a point where there's both domestic and FI inflows, the market should do well at that point. Now, whether that happens 3 months from now, 6 months from now, I don't know. But the answer is that by and large, money will flow into countries where growth is strong, and I think growth is quite strong in India.
Right. Let's look at the other part of the market, Deepak, which is the capex led rally that we saw over the last 10 years. And beginning February 2025, the government has shifted focus towards boosting local consumption. We talked about the income tax benefits, the rate cuts, and now this GST rejig. Do you think the capex story is behind us now? We have all the ports we need, all the roads that are required, airports are in top shape. Uh, is it done?
Well, if you look at the roads in either of our cities, I don't think so, because things on the infrastructure front needs massive rehauls and re-changes as well. I mean, so what, for instance, in Bangalore, we've been having a metro project happening for the last 10 years, and it still needs 2x the size of the current metro projects just to be able to serve the entire city. So it's barely getting started in that sense. I think the same thing would apply even for Bombay, Delhi, Hyderabad. Although there is infrastructure currently there, there'll probably be more. Airports, again, we are looking at new airports coming in outside of Bangalore, outside of Delhi, outside of Mumbai. I think there is a bunch of more activity happening in the ports as well. Port expansions, more ports, and shipping traffic. There is a little bit of there's been a little bit of work in that happening, but I think aage aur bhi hai, like they say. The north-south corridor for there is only a northwest and a southwest. I think northwest and northeast railway corridor that has come up to a certain extent, but there is
No,
phase
what
two,
I
phase
meant
three.
to ask was that we've had this flurry of activity on building our infrastructure over the last 10 years. Now, some of it is in place, and of course, it's a never ending story. I just wanted to understand, is the government realizing that we've reached at a point where now this is a self generating kind of uh, a sector, and maybe other parts require its attention more than what it
Ah,
was earlier hoping?
no, no, I think so. I think, like, for instance, you said domestic consumption. You can't have an economy of this size without factoring in the the point that we need to consume. And when we consume more and more, if we don't allow domestic sources or supply of that consumption, then people will go abroad. So if you don't build up the tourist areas in India, people will go abroad to tour, and it eventually will not be quite as expensive as some of the cities in India actually cost more than going to Southeast Asia to holiday already. So there is a point at which having that domestic consumption story, domestic supply of that, the consumption alternatives, I think that makes a lot of sense. And by lowering tax rates in general, I think puts more money in the hands of people rather than pushing money in the hands of the government.
Yes.
Uh, and hopefully they will do this in multiple ways, right? You could reduce the price of petrol because you're already getting reduced cost of crude from importing from Russia. So if we were to get a little bit of that, I think that will also increase the amount of money in the hands of people, and that will. So if that happens, our consumption, a part of our economy, private consumption is 66% of Indian GDP.
Yes.
You bump India's private consumption up by 2%. That's a 1.5% increase in GDP.
That's true. That's true. And I think there has been a realization that's dawned at uh, North Block in particular, that something needs to be done to boost not only consumption but also ameliorate the kind of pain that the middle class has seen over the last 2-3 years or so. Be that as it may, let's now look at the market from the point of view of an equity strategist who has to deploy money on a regular basis. What doesn't look good to you?
So right now, what's not very interesting to us is perhaps core metals, some parts of pharma, not necessarily all parts, and areas in the that are more commodity oriented. When I say that, I don't necessarily mean just commodities, but in general, that's the thing. Consumer staples, for instance, we think that is very highly valued for the kind of growth that we are expecting in those areas to see. The same thing I would say is the exact opposite in consumer discretionary, where I'd say I want to invest in that because I think more spending power means more consumer discretionary that will happen. But I don't think consumer staples will go on. Hospitals, great idea. Some of the healthcare, other healthcare elements, not so great. Diagnostics, for instance, interesting space, but there's very highly fragmented competition and perhaps a change in regulations that will perhaps limit the amount of money they can charge. While I like consumption, I don't think movie theaters are the most interesting play to be with because we've broad based the source of entertainment of movies, and that's mostly whether it's OTT or it is just online YouTube kind of consumption. Things have changed quite dramatically, and so that part is more interesting. And then of course, what I probably won't invest in currently is PSUs in the financial sector, because I think relatively speaking, the private banks, some of the private banks are in much better shape and much more ready for growth than the private public sector players.
Right. With that, we'll draw to a close, Deepak. What a pleasure, and a very interesting conversation, whether it focused on our problems with America, our future with China, where to invest, what to avoid, and of course, where the markets are headed. Thank you so much for your time, and here's wishing you a happy Friday.
Thank you. Thank you so much. And happy Friday, happy Teachers' Day, happy Eid, and happy Onam to everyone that's watching.
That, ladies and gentlemen, was Mr. Deepak Shenoy, CEO of Capitalmind, which offers both PMS, which is Portfolio Management Services, and a fledgling mutual fund operation. Deepak manages somewhere like 2,000 crore rupees for clients, and is fairly bullish on the market in terms of how this GST rejig, cut in interest rates, and a boost in domestic consumption might take the Lal Street too. Thank you for your time, and have a happy weekend.
From overnight global cues to live Dalal Street moves, we decode what matters for your money today. From stocks to sectors to the top business news, we've got your morning game plan covered. Watch me, Abha Bakaya, as I bring you the opening bell action Monday to Fridays, 9:05 a.m. only on India Today.